Hi, this is Ian Gendler, Director of Research at Valuation. Today, using our digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on valueline.com and our YouTube channel within the next 48 hours. For those joining us for the first time, I want to provide a brief overview of who we are at Valueline. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Valueline Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Valueline's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, including the 1,700 that are included in this service. Valueline does not execute trades for subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, I feel it is important to start with an update on the current economic environment. This content was created by Harvey Katz, Valueline's chief economist. Consumers are showing some indecision. To wit, after spending aggressively earlier this summer, as retail sales surged 0.8% in July, shoppers turned hesitant last month. To be sure, sales did rise 0.4%. However, after backing out higher spending on autos, sales were flat, with declines at furniture outlets, restaurants, and department stores. In fact, only a stellar showing online prevented a more worrisome outcome. The softer retail results, meantime, were countered by large increases in housing starts and building permits in August, with this strength probably attributable to lower mortgage rates. Taking into account this uneven spending pattern, the Federal Reserve has reduced interest rates once more. In fact, leading up to the recent Fed meeting, the only question was whether the rate cut would be a quarter point or a half point. It was the former. Meanwhile, commentary from the bank left the door just slightly ajar for another rate reduction later this year. But even though it didn't close the door on further rate action, investors were not mollified and equities fell just after the Fed gathering ended, before rebounding late in the session. The Fed's move followed aggressive action by the European Central Bank. There, the ECB cut its interest rate and put into place a sweeping package of monetary stimulus highlighted by bond purchases. These efforts were designed to reverse the continent's weakening economic fortunes and stubbornly low inflation. The ECB moves increase the likelihood that the Fed will take additional curative action in the coming year, especially if higher oil prices, following the recent attack on Saudi Arabia's oil production, or other instability in the region, lead to slower economic growth worldwide. These developments aside, much of Wall Street's focus remains on trade, with the U.S. market seemingly hanging on every pronouncement from our government or China. Recently, the news has been better, which has given equities a boost. With third quarter earnings season still a couple of weeks off, and trade talks due to heat up shortly, news on this front will continue to grab headlines. In conclusion, we think investors should retain a sizable stake in quality stocks with upside, using any short-term weakness to add to positions, so long as the economic, global, and monetary fundamentals remain reasonably supportive. We can use Harvey's comments and outlook to create an investment strategy. Thankfully, Valuation provides the tools to put this in action, which I will demonstrate when I get to the screener. Before we formally start our search, please note that I'm already signed in as a subscriber and on the Valuation dashboard. From here, I can access all of the products via the quick links, as well as view daily market commentaries, economic information, as well as general interest articles written by our analyst teams. Let's now start our search for worthwhile investment candidates. For this, I'm going to head to the screener, which can be accessed via the Find Ideas tab. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. For today's search, let's focus on several details that Harvey mentioned in his report. First, let's address quality. While we are bullish in regard to the market over the near term, there are certainly a number of concerns, including trade, economic conditions, etc. Thus, I'm going to weed out risky equities so that we can indeed focus on quality. There are loads of risk measures out there, and that Valuation offers, and I'm going to focus on our time-tested safety ranks. Safety ranks measure the total risk of a stock and are arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge, from within the investment education section of our website. So I click on the safety rank, and I want to focus on stocks ranked 1 or 2. These are the most financially sound companies that we track, and their stocks have a history of relative stability. As you can see, only 464 stocks in our database of more than 5,800 are ranked highly for safety. I now want to make sure our candidates have been successful growing profits, and we will utilize the EPS growth 5-year field. I'm going to set the low threshold to 15%. So these companies have been able to advance profits, on average, by at least 15% over the past 5 years. Historical growth is important, but I also want to make sure that the companies are positioned to continue to perform well. This is where Valuation's 3 to 5 year projections are particularly useful. This is also a good time to mention that Valuation is one of very few research houses that provide financial projections out 3 to 5 years. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. Let's find that field, projected 3 to 5 year EPS growth rate. I'm going to also set the low end to 15%. For the next field, I want to focus on potential upside, which was mentioned earlier. For this, I'm going to utilize a new feature from Valuation, and it is only available to our subscribers. It was developed by our in-house quantitative research team. The 18-month target price range, as the name suggests, seeks to predict the stock's price over an 18-month horizon in terms of a range. In addition to the high and low values of the range, the percentage difference between the current stock price and the midpoint of the range is provided. The percentage may be thought of as the most likely potential profit. The larger the percentage, the greater the possible price appreciation. The 18-month target price range is only available for the 1,700 stocks covered in the Valuation Investment Survey, and this purely quantitative measure is displayed on our digital reports. We have also added the 18-month midpoint percentage to our online stock screener, so we can use it today. Importantly, this metric will soon be rolled out on our classic one-page stock reports, so I encourage subscribers to look out for this over the near term. Let's select the field. For the midpoint, I'm going to set the low end to 20%. Thus, according to this measure, the most likely scenario calls for the following stocks to increase in price by 20% in 18 months. Okay, 6 results, which is easy to digest and analyze. All of these stocks may fit nicely in a portfolio that values quality and risk-adjusted upside. I personally evaluated all 6 stocks below, and following my research, I have decided to make Progressive Corp, ticker PGR, today's one stock to buy right now. Before I provide more information about Progressive, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden, so you can create your own customized stock report. Once the presentation is altered to your liking, you can save the changes from the sliding horizontal action bar. The next time you come to this report, it will look the way you set it up, and you can apply these changes to other equities. Most of you are probably familiar with Progressive, since they aggressively advertise, but let's get some quick corporate information from the Business Overview module. The Ohio-based company offers private automobile insurance throughout the United States. It employs more than 37,000 individuals and has a market capitalization that exceeds $44 billion. Moving on, our digital reports possess a great deal of information and analysis, so let's take some time to look at details about Progressive. The institutional ownership module can provide clues as to how the hedge funds and investment banks feel about the stock. This, of course, can be quite helpful. As you can see, over the past 2 quarters, institutional buys have greatly exceeded sells. It can also be helpful to read up on industry fundamentals. From the Industry Analysis module, we can pull up our last report, and here's a quick excerpt about the health of the industry as a whole. 2019 continues to shine. Many companies under our coverage enjoyed year-over-year earnings gains during the first 6 months of the year. True, the U.S. experienced its fair share of catastrophes during the period, including windstorms, tornadoes, and wildfires, to name a few, but many insurers were able to compensate for these risks through rate increases. Last year, it should be noted, was a difficult catastrophe year for the insurance industry, with 2 major hurricanes, Florence and Michael, ravaging the continental U.S., resulting in billions of dollars in insured losses. These storms gave insurers the wherewithal to raise prices during this year's policy renewal season in order to compensate for the increased risk. Valueline obviously provides a great deal more industry-related content, which I recommend that you revisit. For this exercise, since we don't have tons of time, it is safe to say that the group's prospects are bright. The Peers module can also provide valuable info. For instance, looking at the price-to-earnings ratio of Progressive versus its industry peers, and PGR is trading at a lower multiple. This suggests that PGR is trading at a relative discount. Moving to the Valuation module, we see Progressive's historical annual performances, as well as Valueline's estimates for this year and next in bold. A quick scan reveals that PGR should continue to increase underwriting income, earnings, and other valuation metrics at good clips. Clearly, from a numbers standpoint, there's a lot to like here, and I encourage interested investors to review the many other modules that we provide. I now want to highlight our classic PDF reports, which are available for all digital subscribers. They are available at the button at the top right. Let's see what our analyst has to say in the commentary. Many subscribers consider this the most important part of our reports. Senior analyst Alan House stated the following in his recent report. Progressive is on track for a good year in 2019. After a roughly flat start to the year, earnings picked up momentum during the June quarter. Next year doesn't look too shabby either. ShareNet ought to climb at a healthy clip in 2020, assuming current industry fundamentals continue over the next 18 months or so. We believe that pricing trends ought to remain favorable as the industry, in aggregate, benefits from a relatively high level of catastrophes last year. What's more, Progressive's combined ratio should remain in positive territory and above the industry average, given its stringent underwriting standards. Progressive has a strong niche in the auto industry, helped, at least in part, by a successful marketing program. As for the stock, we think it offers broad appeal. It is ranked favorably by our ranking system for timeliness, suggesting it will outperform the broader market over the next 6 to 12 months. As mentioned earlier, it stands out when it comes to Value's new 18-month target price range. PGR's long-term prospects also appear favorable, and this issue offers worthwhile 3 to 5 year appreciation potential. Simply put, PGR may be a good addition to most equity portfolios, and it is today's one stock to buy right now. This marks the end of the formal presentation, and I will now tackle your questions. Give me a couple minutes to look through. All right, here's one question. Is it possible to get a list of past recommendations and the date recommended? Well, we post all of these presentations on our website and YouTube, so you could go into each one, but it's not something that I have on hand. How frequently should we use the stock screener feature for most number of stock selection, daily, weekly, etc.? I'm assuming just you're asking how often the data is updated. Data via the screener are updated in 3 intervals. A good amount of it is daily, especially when it comes to the stock price and all the fields that are based off stock price. We update our ranks and a lot of our other proprietary data on a weekly basis. And of course, a lot of data is updated when a company reports quarterly financial results. As far as how often to use it, I guess it really depends on the user. If you're aggressively looking for new holdings or to replace current holdings, you're going to use it more often. If you're only someone who likes to make trades on a quarterly basis or occasional basis, you'll use it likely less frequently. I hope that answers that question. Is the insurance sector trending similar to Progressive? Yeah, I think we covered that. We think both the industry and Progressive are trending in the right direction. We think their prospects are good. I will say, while preparing this, it seemed like Progressive's prospects are better than the industry average. How can we create the Valueline 600 index that comes with the printed version? I assume you mean how can you create the 600 in the screener? Currently, that feature does not exist, but we actually are working on adding the ability to screen by coverage universe in the screener, and that we're hoping for that update within the next couple months. Here's a question about PGR's dividends. Let's take a look at the report. As you can see in the footnotes, so they changed their dividend policy. As you can see, they used to pay a variable dividend at the beginning of the year and special dividends on I guess you can call that a regular basis. And they've returned to quarterly payouts beginning in 2019. So they've changed their dividend policy, and now they're paying on a quarterly basis. I know obviously that looks like a reduction, and I suppose it is, but this stock was never really much of a yield play. As you can see just from the past many years, it never really offered, I wouldn't say too much of a competitive dividend. Are we able to create a digital version of the printed version that is published and mailed? Well, obviously, our classic reports are accessed via the website, like I'm pulling up here. And then, of course, you can set up the digital report any way you want, and then print that. I assume that answers that question. Is there a model you could use to enter all of your stocks in a portfolio? Yeah, there's two ways. We have a watch list function, which you can add all of your stocks to. So here's one I created a while back for income stocks. So you can create a new one. There's a max of 25 holdings. And we also have a portfolio tracker if you want to add in more details. For instance, the prices you bought a stock at or capital gains you've realized. So both of those are available for subscribers. Here's a question about the 18-month. What is the estimated price increase over the next 18 months? All right, so let's go back to the PGR page. As you probably saw on the screener, it was 20%. But I also show you the range, and then the midpoint of the range, as I mentioned, is the most likely. So currently the price is $77. The high and the low is $66 to $118. That comes out to a midpoint of $92, or roughly 20% above what the current price is. Is cash flow important for PGR, and how is it? Cash flow is important for all public companies. Make sure that they can fund operations, dividends, capital expenditures, etc. And if we take a quick look at PGR, they generate quite a lot of cash. They don't have a lot of long-term debt relative to the size of the company, $4.4 billion, which is only 25% of capital. Interest payments are not onerous, and they have a very healthy balance sheet. And of course, with net profits exceeding $3 billion, likely this year, next, and going forward, they generate plenty of cash. Could also mention that the company's financial strength grade, which looks at the balance sheet heavily, is B++, which is above average. If you run the screener that was the subject of today's presentation and you save it, will it update going forward? Yes, the field will stay as well as your parameters, but the data will get updated around it. What are the 18-month price ranges based on? All right, well, there's an explanation. If you just hover over the explain button. It's a quantitative formula, so I can't provide, and I personally don't know the secret sauce. But I'll tell you that recent price action, recent financials, as well as the analyst estimates are all included in the calculation. Let me do a quick scan. Oh, is there any way to screen for stocks that pay dividends in specific months? No, unfortunately, we don't do that. We you can search by dividend yield, dividend growth, but not specific payment dates. On each individual report, we do tell you when the payments are expected, but I know that's not what you're asking. Does volatility play a role in Value Line's screening method? Well, it certainly did for today. The first field we used was the safety rank, and volatility is a component in that. We chose stocks that were ranked favorably for safety, meaning they're the less risky companies, so the less volatile. And volatility is also a component in the 18-month calculation. The more volatile the stock, the wider the range. How much is price change a factor in your determination of a timeliness or performance ranking? Recent price action and momentum is a major factor in those proprietary calculations and ranks. Value Line is really good at identifying good stocks. Thank you. But what tools are there to help identify whether the stock is priced right? That's where our estimates and ranks and projections come in. Obviously, if we thought a stock was overvalued, for instance, it wouldn't be ranked necessarily favorable for timeliness. It wouldn't have a good 18-month score. With Progressive, I pointed out the low PE relative to its industry peers. So all of that obviously would take price into account. And we provide a whole host of other fields that are price related. You could look at price to book value. That's another field in the screener, and many others. Relative PE to see how the PE is compared to our entire Value Line universe. There's a whole host. I find that past earnings beats are an important factor in finding good stocks. Yeah, we provide the earnings results as well as our estimates. We don't have it for every company, but let me take a look. So here you can see the earnings per share, our estimate, and then the surprise percent. So yes, it's in the earnings module. Safety rating, does safety rating incorporate a version of the old beta number? Safety and beta are of course not the same thing, but they can be used in similar fashion. If you wanted to find less volatile, less risky companies, you'd look at stocks with below average betas or betas below 1. So sure, but I don't want to say that they're the same because they're not. Since the cash flow is high and dividend yield is low, what's Progressive doing with the cash to drive the company forward? Well, we've already mentioned a couple times they aggressively advertise, as do a lot of other companies in the insurance space. For anybody that watches TV, it seems like Progressive, Allstate, and Geico dominate a lot of the commercial time. So that's a big part of what they do with the cash. And of course, other things to get to gain new customers, customer retention, things like that. And of course, they're always going into new states, new territories, new offerings. Is there a list of anywhere of the companies that are publicly owned in each state? So we offer, you can look at what where companies are domiciled by country. We have that in the screener, but not by state. It's something that's on the front page of every company's quarterly reports or 10Ks, 10Qs, etc. But no, we don't offer the ability to screen by state. Do you look at float or derivative markets when looking at pricing? Float we look at very closely, especially when we're thinking about adding new stocks to the Value Line Investment Survey. We won't launch coverage on a company with low float. We want to make sure that there's an active market, a significant number of shares outstanding. So when we recommend a stock, people can buy it. And when we recommend a sell, people can sell it. The derivative markets, admittedly, we don't look at as closely. All right, that seems to be all the questions. I'll wait another 10 or 15 seconds to see if anything else comes in. Great questions, and I appreciate all the participation.